In the ever-evolving world of finance and investment, cryptocurrencies have emerged as a new and intriguing asset class. While they have captured the attention of both retail and institutional companies and investors, they have also raised questions about their role in traditional financial markets, particularly in times of economic turbulence. One scenario that has been discussed is the potential benefit of cryptocurrencies in the event of a collapse in US Treasury bonds. And cryptocurrencies, with Bitcoin leading the pack, have often been hailed as digital alternatives to traditional investments like stocks, bonds, and precious metals. Their unique characteristics have led some to consider them as potential hedges and safe havens in times of economic uncertainty. One of the primary reasons why cryptocurrencies might benefit in the event of a US Treasury bond collapse is their role as a hedge against traditional markets. When conventional investments falter, investors often seek diversification. Cryptocurrencies offer an enticing option because they have historically shown little correlation with traditional asset classes. Investors may allocate a portion of topics that portfolios to digital assets to spread risk. And Bitcoin's moniker as digital gold stems from its perceived ability to store value. If confidence in fiat currencies or government debt wanes due to economic instability, investors might turn up to Bitcoin as a store of value. Its limited supply, capped at 21 million coins, makes it resistant to inflationary pressures, in contrast to government's ability to print more money. Inflation concerns can further drive Bitcoin adoption in the face of US Treasury bond collapses. Investors often seek assets that can preserve their purchasing power when fiat currencies depreciate. Cryptocurrencies, particularly Bitcoin, with its deflationary supply model, have been viewed as potential hedges against inflation. In this context, a collapse in US Treasury bonds due to inflation fears could prompt more investors to explore cryptocurrencies. The global nature of cryptocurrencies is another factor that could attract investors during times of economic uncertainty. Digital currencies are accessible and tradable worldwide, allowing international investors to diversify for their portfolios beyond traditional assets that may be more regionally constrained. In a globalized economy, this accessibility can be appealing when facing uncertainties in any particular region. However, it's crucial to acknowledge that cryptocurrencies are not a guaranteed safe haven. Their high volatility and speculative nature mean that their prices can fluctuate dramatically, and investors shouldn't approach them with caution. The relationship between Bitcoin and traditional financial markets is intricate, and the future remains uncertain. In other words, cryptocurrencies like Bitcoin may be viewed as potential beneficiaries in the event of a collapse in US Treasury bonds. Their qualities as a hedge, store of value, inflation hedge, and globally accessible asset class could attract investors seeking refuge from traditional market turbulence. Very exciting to put the contest market back, and what kind of do is what the stock is best tests out 5 new terms on 5 terms and vest that risk, because the recent effects are doing is recognize the US Treasury bond collapse